In 2004, two Harvard students co-founded a company together. One of them is now worth over $170 billion. The other was worth $1.6 billion at IPO and had already left the company 6 years earlier. Same founding moment, same dorm room, same handshake, completely different outcomes. Eduardo Saverin owned 34% of Facebook at the start. By the time the company went public in 2012, his stake had been reduced to approximately 2%. He did not sell it. He did not give it away. It was diluted, legally, structurally, and deliberately, while he was still a co-founder on record. Zuckerberg, meanwhile, had engineered a share structure that gave him majority voting control over a company worth hundreds of billions of dollars, while owning a minority of its total shares. 4 mechanisms explain exactly how this happened, and why the same pattern keeps repeating every time a founder builds something valuable. This is not a story about who wrote the best code. This is a story about ownership. October 2003, Harvard University, Cambridge, Massachusetts. Mark Zuckerberg is a 19-year-old sophomore studying computer science. He builds small web projects in his dorm room, not for money, but because he is compelled to. His instinct is to build systems that connect people. Eduardo Saverin is a junior. He is Brazilian-born, commercially minded, and already a member of the Phoenix Club, one of Harvard's most exclusive social organizations. He understands networks. He understands money. He has already made a small fortune trading oil futures as a freshman. In late 2003, Zuckerberg builds FaceMash, a site that pulls student photos from Harvard's database and asks users to rate them side by side. The site crashes Harvard's servers within hours. Zuckerberg faces disciplinary proceedings, but the traffic numbers tell a different story. Students want this. By January 2004, the idea evolves. A social network, not a rating site, a digital campus directory where students could connect, share, and communicate. Zuckerberg needs 2 things, a programmer and capital. He approaches Saverin. The arrangement is straightforward. Zuckerberg provides the technical architecture. Saverin provides the seed funding, approximately $19,000, and takes on the business operations side of the company. The initial ownership split. Zuckerberg receives 65%. Saverin receives 34%. The remaining 1% goes to a third early contributor. This split reflects their contributions at that moment. Zuckerberg is the builder. Saverin is the financier and operator. On February 4, 2004, the Facebook launches at Harvard. Within 24 hours, 1,200 students have registered. Within 1 month, it expands to Yale, Columbia, and Stanford. The product works. The question now is how far it can go. The ownership split at founding is the most consequential financial decision most companies ever make. And it is almost always made before anyone knows what the company will become. Saverin's 34% was allocated based on his contribution at that specific moment, seed capital and business development. Zuckerberg's 65% reflected his role as the primary builder of the product. What neither party fully accounted for was how future capital raises, new hires, and corporate restructuring would interact with that original split. Early equity is not permanent. It is a starting position. How it changes depends entirely on what happens next and who controls the legal structure when it does. By summer 2004, Zuckerberg makes a decision that will define the company's trajectory. He moves to Palo Alto, California, to run Facebook through the summer. Saverin remains in New York, pursuing internship opportunities. The geographical separation is not just physical. It reflects a diverging sense of priority. In Palo Alto, Zuckerberg enters a different world. Silicon Valley operates on a specific logic. Raise capital aggressively grow fast, dominate the market. Speed is the competitive advantage. Ownership is the price of speed. In June 2004, Sean Parker, co-founder of Napster and an experienced Silicon Valley operator, begins advising Facebook. Parker understands venture capital, he understands term sheets and dilution and board structures. He becomes a bridge between Zuckerberg and the investment community. Parker introduces Zuckerberg to Peter Thiel, the co-founder of PayPal and one of Silicon Valley's most respected angel investors. In June 2004, Thiel invests $500,000 in Facebook in exchange for approximately 10.2% of the company. This is Facebook's first outside investment. The mechanics of this transaction matter. To give Thiel 10.2%, new shares are created and issued. Every existing shareholder's percentage ownership decreases. This is standard dilution. It is how venture-backed companies function. Saverin's 34% begins to move. Meanwhile, the operational dynamic is shifting. Saverin is responsible for opening a bank account for the company, managing early advertising relationships, and overseeing business functions remotely. But the center of gravity for all real decisions, product hiring strategy, is in Palo Alto, where Zuckerberg operates daily. There is a growing imbalance. Zuckerberg is building the company in real time. Saverin is contributing capital and business support from a distance. In a fast-moving startup, physical presence and operational involvement translate directly into influence. By late 2004, Facebook has over 1 million users. The company is expanding beyond universities into high schools. Revenue is minimal, but user growth is aggressive. More capital will be required. Every time a company raises external capital, it issues new shares. New shares dilute existing shareholders. This is not a betrayal. It is the fundamental mechanics of equity financing. The question is never whether dilution will happen. The question is who controls the terms under which it happens. Investors receive equity. Founders retain control. But only if the legal structure is designed to protect it. And the legal structure is only as protective as the person who drafted it. Saverin was a co-founder and significant equity holder, but he was not in the room where the structural decisions were being made. In startup finance, proximity to the decision-making process is not a courtesy. It is a form of power. This is where the story turns. In the summer of 2004, Facebook is incorporated in Delaware as a new entity. Delaware incorporation is standard for venture-backed companies. It provides legal flexibility, favorable corporate law, and the infrastructure investors expect. But the transition from the original informal partnership to a Delaware corporation is not a neutral administrative act. It requires decisions about share classes, voting rights, and ownership allocations. Those decisions happen in legal documents that most people never read. In the new corporate structure, shares are allocated. According to accounts of the period, including the legal proceedings that followed, Saverin's shares in the new entity were structured differently from Zuckerberg's. More specifically, Saverin's role and ownership were not directly transferred on a one-to-one basis from the original arrangement. In early 2005, the situation escalates. Accel Partners, a prominent venture capital firm, is preparing to invest approximately $12.7 million in Facebook. This is a significant capital raise. It requires new share issuance. New share issuance means dilution for all existing shareholders. Here is where the critical event occurs. According to the legal complaint Saverin later filed, new shares were issued to employees and others during this period, and Saverin's stake was diluted substantially, more than would be explained by the Accel investment alone. The allegation was that shares were issued in a manner designed to reduce Saverin's ownership percentage specifically. By the time Saverin's legal team examined the structure, his stake had been reduced from approximately 34% to somewhere between 5 and 10% of the company, depending on which share class and which moment in time you measure. Saverin was still listed as co-founder. His name was still on the company, but his ownership had been fundamentally altered. He filed suit against Zuckerberg and Facebook in 2005. The lawsuit alleges that his shares were improperly diluted. The case settles out of court. The terms are confidential, but the outcome is documented. Saverin receives a settlement, retains a stake in Facebook, and is confirmed as co-founder in the company's official records. His final stake at the time of Facebook's 2012 IPO is reported at approximately 2%. 2% of a $100 billion company is still approximately $2 billion. Saverin is not poor, but the distance between 2% and 34%, measured at IPO valuation, represents tens of billions of dollars. Dilution is legal, it is routine, and it is one of the most powerful tools available to whoever controls the corporate structure. Here is how it works. A company has 100 shares outstanding. You own 34. Your ownership is 34%. The company issues 200 new shares to investors and employees. Now there are 300 shares outstanding. You still own 34 shares, but 34 out of 300 is 11.3%. You did nothing wrong. You sold nothing, but your ownership was reduced by 2/3. The important detail: the people who control which shares are issued, to whom, and at what price are the people who control the outcome of dilution. Founders with majority voting control can influence these decisions. Minority shareholders typically cannot block them. Saverin was a minority shareholder in a company where he did not control the corporate governance. That structural reality determined his financial outcome more than any single decision he made. Facebook goes public on May 18, 2012. The IPO values the company at approximately $104 billion. It is one of the largest technology IPOs in history. Zuckerberg's stake at IPO is approximately 28% of total shares. But through a dual-class share structure he had engineered years earlier, he controls approximately 57% of the voting power. He owns a minority of the economic interest, but a majority of the decision-making authority. This is the architecture of control. Class B shares, held primarily by Zuckerberg, carry 10 votes per share. Class A shares, sold to the public, carry 1 vote per share. The company can raise billions from public investors without Zuckerberg surrendering a single decision. Saverin's approximately 2% stake at IPO is worth roughly $2 billion. He had renounced his United States citizenship in 2011, relocating to Singapore, a move widely covered in financial media at the time. By 2024, Facebook, now Meta, has a market capitalization exceeding $1.3 trillion. Zuckerberg's stake, adjusted for share sales and grants, remains substantial. His net worth exceeds $170 billion. Saverin's net worth is estimated at approximately $20 billion, built significantly through investments made after Facebook. He became a successful venture investor in Southeast Asia. The gap is not a reflection of talent. Both men are accomplished. The gap is a reflection of ownership structure at the moment of maximum value creation. Zuckerberg's greatest financial achievement was not building Facebook. It was designing the legal structure that kept him in control of Facebook while distributing its economic ownership to investors and employees. Dual-class share structures separate economic ownership from voting control. Zuckerberg could sell shares, dilute his economic stake, and still retain decision-making authority over the entire company. Saverin had economic ownership early on. He did not have structural control. When the corporate structure was designed, without his full participation, the governance architecture was built around Zuckerberg's authority. Ownership percentage and voting control are not the same thing. Understanding the difference is the difference between holding equity and holding power. The Facebook story follows a pattern. Eduardo Saverin co-founded Facebook, provided early capital, and contributed to the company's initial operations. His ownership was diluted through corporate restructuring during a period when he lacked operational presence and structural control. He captured a fraction of the value his early contribution helped create. In each case, the pattern is identical. Creators, builders, and operators generate value. Owners of the structure capture it. Saverin generated value. He was present at the beginning, but he did not control the structure, and the structure determined the outcome. Zuckerberg understood something early that most founders learn too late. A company is not just a product, it is a legal architecture, and whoever designs the architecture determines who benefits from its appreciation. The lesson is not that Saverin made one fatal mistake. The lesson is structural. Once a founder loses the ability to control corporate governance, through distance, through lack of legal sophistication, or through simple inattention, the economic outcomes of the company can diverge significantly from what the original ownership split implied. Being first does not guarantee ownership. Being present does not guarantee control. And founding a company does not mean owning the compounding returns of what that company becomes. The wealth flows to whoever holds the structure. It always has.